Hi, my name is Fan Yang, your Chief Currency Analyst here at ForexMinute.com. You're watching today's Forex video briefing. It is Thursday, April 23rd, and we're in the morning part of the US session. The New Zealand US dollar pair is reversing last week's rally. Let's take a look at the charts and assess the technical development. In the 4-hour chart, we can see that price has rallied last week from about 0.7425 to about 0.7740. This week, the Kiwi dollar formed a price top and broke below the 0.7633 support during the April 23rd session. The decline started during the April 22nd session and looked very sharp as it continued through into the 23rd session. Now, the Kiwi US dollar pair is in a choppy market in the short to medium term, in a choppy consolidation. So this bearish swing is not very helpful in terms of giving us a clue of the direction in the medium term. So looking at the daily chart, you see it's been chopping, and this dip here is still within the context of this choppy consolidation correction. So not much of an indication for the medium term. But in the very short term, we might say that, after this dip, the 0.7633 to 0.7656 area could provide resistance and should be monitored for resistance if there is a pullback. So, but if price climbs back above 0.7660, for example, and the RSI climbs back above 60, then the choppy bullish correction mode is still in play. However, if price falls below 0.75 and the 4-hour RSI dips below 30, it should do that. The Kiwi dollar might start to revive the prevailing bearish trend seen in the daily chart. Now in the RSI during this choppy consolidation has not broken below 30, so it has not signaled that bearish the initiation of bearish momentum. So if the RSI does dip below 30, that's a change in some pattern, some type of pattern within this bullish choppy correction. So that's why if price falls below 0.75 and the RSI below 30, we might consider the market returning to the bearish price action that we see in the daily chart. Okay, so you see that before this consolidation, the market has been bearish. Okay, and you see that a break below 0.75 would break below some key support factors. Okay, including the 50-day simple moving average, meaning the price would return below all three 50, 100, and 200-day moving average, and below 0.75, price would break below this rising trend line. So that would likely revive the bearish trend, at least in the short medium term, with pressure towards the 0.71, 76, 0.72 lows on the year, and then we'll see from there. If the US dollar is still strong, there is still a chance of a break lower than that, because the prevailing trend, as you can see, is still intact. And one other evidence that the prevailing trend is intact is that the RSI in the daily chart has held below 60, which represents the maintenance of the prevailing bearish momentum. And that wraps up today's Forex video briefing. Thanks again for watching. Trade safe, trade well.